Hi there, my name is Cade Johnson. I'm the analyst here at Petros Family Wealth. You're watching this video today because you had an investment in a structured income note that lasted about 2 years and got called recently for a total return of 24.6%, equates to 12.3% annualized. I'm going to go over all the details. We appreciate your trust and confidence in us with these types of notes. We realize they can look a little bit complex on the surface and confusing. So the goal of these videos is to provide more clarity, as we feel these investment vehicles are very powerful to help enhance potential returns in your overall portfolio. This specific note, like I said, lasted about 2 years. It was purchased on January 29th, 2024 and just matured on February 3rd, 2026. It was issued by Citibank. And the underliers this time were three different ones: the S&P 500, SPX, the Russell 2000, RTY, which is smaller companies in the US, and KRE, which is the Regional Banking ETF. Regional banks are smaller companies, so it is a little bit similar play to RTY in that small cap space. The term was 4 years potentially, and as long as those three underliers do not drop more than 30% from original purchase, you, the client, are going to collect 12.3% of annual interest, but this is paid in monthly installments. So that equates to a little over 1% per month as long as those underliers don't drop below that level. Let's go down to this chart and show you what happened over the life of this note. Purchase date was over here on the far left, and each vertical line striking down represents 1 month. At the 1 month mark, we're going to take a snapshot and say, okay, were those three underliers, are any of them down more than 30%? If not, cool, you collect your 1+% for that month of interest, you get the green check mark, we move on to the next month. You can see this lasted a little over 2 years, and no coupons were missed at all, right? None of the underliers dropped below that 30% threshold at the end of a given month. That equates to a total return of 24.6% over this time frame. Again, a 12.3% annual return for an income-oriented note is very, very solid and above average equity returns throughout history as well. Worst case scenario, right, there's principal protection of 40%. This would have only mattered if the note lasted the full 4 years to maturity, which would have been February 3rd, 2028. If somehow the S&P 500, let's say, was down 39% after 4 years, you, the client, would receive your full original investment back because you're not past that threshold of 40%. But if the S&P was down 41% at maturity, you would be down 41%. So that 40% protection threshold is a cliff, or essentially a barrier protection, where if you go past it, it's 1-for-1 downside. But if you're above it, you would get your money back in that negative scenario. Thankfully, we don't have to resort to that option, right? This note lasted about 2 years because Citibank has the option to call it back at any time after 6 months. They can call it back if all underliers are positive. It lasted 2 years though, and so to us, it was very beneficial for Citi to not call that note back immediately, because you, the client, were collecting right over 12% of annual interest on this note and didn't miss any coupons. What do we compare this to? We usually use the Bloomberg US Aggregate Bond Index as a proxy for how the fixed income space performs. This chart shows the performance of that index over the same time frame, roughly from the purchase date of January 29th, 2024. And over the same period, the Bloomberg US Ag managed a 9.6% total return, roughly. So again, to to get 24.6% is a whole lot better than that 9.6, right? Pretty good outperformance for this type of structure for an interest-oriented investment. I hope this video helped explain the features a little bit. If you have any questions, feel free to reach out to your advisor. Happy to help explain anything else you need. Otherwise, thank you for watching and have a great day.